Good afternoon. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. Before we get started, please like, comment, and subscribe, and be sure to visit the Pacific Point Research Lab on our website at pacificpoint.net/research-lab. And while you're there, be sure to sign up to receive our research delivered directly into your email inbox. The Inflation Reduction Act of 2022, signed into law on August 16th, contains a new 1% excise tax on the repurchase of corporate stock, effective for tax years starting after December of 2022. Coupled with the new excise tax, weaker CEO confidence in the economic outlook may cause a slowdown in buybacks in the quarters to come. Today, we're going to develop a very basic framework around the evaluation of sustainable and supportable EPS growth, because as you'll see in a few moments, not all long-term earnings growth is created equal. Let's go ahead and get started with the share buyback conundrum. So there's four ways companies produce EPS growth. Acquisitions and dispositions. This is sustainable and supportable. We're going to actually take a look at automatic data processing, but as you'll see, there's four little stars behind ADP as well as Apple on the next point. And all that means is I could have chosen any number of companies. So again, this is a very common model, very sustainable, very supportable if you know the business of the company. And this is something they've been doing successfully for years. So we'll talk about that in just a moment. The second point is they can grow EPS organically, right, through reinvestment. Again, this is probably one of the more common manners in which organizations produce EPS growth. And again, supportable and sustainable, but you got to know the business model. The next two are problematic and require a deeper analysis, and we're going to spend some time on this: cost cutting and share buybacks. We're going to look at Apple, Microsoft, automatic data processing again, and Bank of America. The next slide, we're going to take a look at acquisition, disposition. The first company that comes to my mind, just because I had a personal experience with automatic data, is ADP. I actually worked for them for several years. They had acquired a company that I worked for early on in my career. So I got to witness this business model firsthand. In this price and earnings chart, you'll see that price line here in blue, and I want you to see how well tailored this orange operating earnings line, this trailing 4 quarters adjusted earnings line is. So in other words, even through recessions, and you can just see how stable and steady this earnings line is. And this is really ADP's business model. They literally have mandates that these member companies or member divisions within their firm have to meet, revenue targets, cash flow targets, margin targets. And they do a ton of acquisitions. And if you don't end up meeting those requirements, your division will likely be disposed of. And you can see that forecast earnings growth trajectory just mirroring that model. So if you look up the number of acquisitions that automatic data processing does, they just do a staggering amount of acquisitions. And they dispose of business units very, very quickly if they begin to underperform. So a really good model to look at here, again, ADP. We're not going to spend too much time on these first two. They're pretty obvious, right? So organic growth, probably everyone thinks of Apple when they think of organic growth. And so what you're looking for here specifically in terms of organic growth is, keep in mind that in 2001, the iPod was basically brought to market. So you can see that kind of that earnings lift here. And then in 2007, we had the iPhone. And again, in this price and earnings chart, you can see just what happened to earnings here. You can see what happened to the price. It really hasn't stopped. They've developed this ecosystem that both of those products have thrived on for years. So the manner in which we analyze these types of stocks is we've got a lot of different charts we can use. The very first one that comes to my mind that's a really good framework is to take a look at R&D relative to sales. And this is another reason why in our research lab, we don't use screeners, believe it or not. And if I had more time on this particular webinar, we could dive a lot deeper into this. But imagine here for a moment I mentioned in 2001, the iPod was released. I want you to take a look at this R&D relative to sales and then watch it plummet here in 05 and 06. And the reason why it plummeted is not because R&D backed down. Actually, R&D continued to accelerate. What happened is sales went parabolic, which ended up driving this ratio of R&D to sales lower. So if you were using a screener, you would think, well, Apple's not doing as much R&D relative to sales, so perhaps growth is going to slow. And then you hit 2007 and the iPhone was released. Well, again, we had a little bit of a pop-up in R&D relative to sales, and then R&D relative to sales plummeted again. So what happened here, it wasn't that R&D slowed down, it just continued. What ended up happening was sales again went parabolic for Apple, and that drove that ratio down. And now you can see as of 2012, R&D has actually started catching up to that sales growth, and we're getting back to that staggering amount of almost 6.52% of sales. Think about that for Apple sales. We all know what sales have done here since they released the iPod and the iPhone. We're almost back to 6.5% of that being dedicated to reinvesting into their own business just in R&D. So that's just a staggering amount. Okay. Now keep in mind that it's not like Apple doesn't do acquisitions, right? So in 2021, I recall reading several interviews. One was BBC, and there was a couple in Wall Street Journal where the CEO, Tim Cook, was quoted saying that Apple has acquired 100 companies over the last 6 years. And if you do the math, that equates to Apple purchasing a new company every 3 to 4 weeks. So it's not that they don't grow via acquisition. They certainly do. It's just that when you think of somebody growing organically or a corporation growing organically, Apple does that, and they acquire companies for growth as well. So they do both. Next slide, we're going to continue on with this Apple theme, and we're going to look at cost cutting and share buybacks. Okay, so this is 3 and 4, and I lump them together because the framework that we use to analyze this is really a single framework. And you can't really separate the two. And the reason why is because they kind of go hand in hand, and the analysis that you do can be done very quickly in a model such as the one you see on the screen. And we're going to go through this. I know it looks ugly. It looks just like a bunch of numbers, but it's actually very, very easy to utilize a model like this. Okay, so the first thing that my eyes go to is this shares diluted column. So I want to take a look at share buybacks. I want to take a look at cost cutting, and I want to take a look at the entire landscape of what Apple has going on. So this type of a framework allows us to really get a microscope on the prior 8 quarters and the forecast 4 quarters forward to determine the sustainability and supportability of their growth relative to their 1, 3, 5, 10, 15-year least squares trend rate of growth. Okay. So let me give you a specific example here. Let's just take 1 quarter in particular, and my eye is just going to go to this March 2022 quarter. And again, notice the share buyback that they've got in place. A little bit of a taper going on here, but negative 4.6. You can see the shares, the weighted average shares outstanding diluted on the decline. You can see the year-over-year percentage decline. And you can see that they've actually been buying back their stock since 2012. So this is going to be the weighted average shares that are actually used to calculate this earnings per share. So when we look at these 4 columns, we've got revenue, revenues per share, earnings, and earnings per share, and their year-over-year percent change. Okay. So you can see this tremendous amount of operating leverage that Apple experienced during COVID, right? December of 2020, March of 21. Take a look at these earnings growth rate numbers relative to their revenue growth. They were posting 54%, 36%, 29% revenue growth, and they were driving 120%, 102%, and 69% earnings growth. So we know that a lot of that's margin expansion, right? We can see that net margin expansion here. So a lot of margin increase, you could call it cost cutting, but a lot of it, again, is going to be more or less related to operating leverage for a company like Apple. They've already sunk the expenses. Every incremental sale is just going to allow them to yield more and more net income. And that's what this is telling you here. So we go from 19.6, 25.8, 26.3, 26.7. So this is just tremendous operating leverage for Apple in here. And then we get down to this March 2022 quarter, and you can see now we're starting to normalize out from that post-COVID growth. Okay, so this is kind of where the rubber hits the road for Apple, and this is where we kind of got to roll up our sleeves and go, okay, how is this going to normalize out in a post-COVID world? And that's the reason why my eyes were drawn to this March 2022 quarter. So the way we look at this is that if you're just reading the press releases and you're just watching CNBC, as soon as Apple reports their adjusted EPS, it looks like it's about 9% growth. Okay. But keep in mind that if you take into account that 3.1% share buyback, you're really only looking at 6% growth. So depending upon how you want to calculate your percentage changes, I would like to think of that as Apple actually manufacturing about 3% in terms of earnings growth. Others would say, well, that's a 50% increase. You're going from 6 to 9, but let's just call it 3 for the sake of argument. And you can see that is just an absolutely enormous amount of EPS growth that's been manufactured for Apple because of the share buyback. Now, what's interesting is you can see that they grew revenues at 9%, right? They manufactured 6% in terms of earnings growth. So perhaps a little bit of margin slippage there is what we're seeing. But with that share buyback, they were able to prop it up to where it was even, okay, with revenue growth, which is really, really interesting. So if we go to the trailing 12-month number, you can see something interesting here as well. The cumulative effect of share buybacks over the prior trailing 4 is basically 4%. So if you're looking at the reported growth in EPS, not taking into account share buybacks, you're thinking that Apple grew at 19% earnings per share, when in aggregate they grew at 15%. And they manufactured that 15% earnings growth off of only 12% revenue growth. So call it cost cutting, call it operating leverage, right? When a company does that year after year after year after year, that's more operating leverage. If I were to show you a chart of their net margins, you can see that their net margins have literally been expanding for years on end. And that's what we look at down here in this least squares growth area. So the framework you want to use here is when you're looking at the impact of what the share buyback is doing, you compare your diluted growth relative to your aggregate growth. Okay. And then when it comes to cost cutting or margin expansion, if you will, you're looking primarily at the difference between revenue growth and earnings growth. So if you're experiencing cost cutting, then you're basically growing your earnings at a higher rate than your revenues. And then the question is, in both cases, right, what's the sustainability of this model, right? So the framework is you have to ask yourself, how many more shares can Apple buy back? How long can they continue the share buyback? They've been doing it for years, right? Literally here since 2012. And then the same thing goes for the cost cutting, right? Or the margin expansion. How far can the cost cutting go, right? How far can this net margin expansion go? And so we look to the least squares growth rates to answer that question in terms of sustainability. So you can see here, if you go all the way out to the 20-year, they've been basically experiencing operating leverage or cost cutting, if you will, for literally the last 20 years. Okay. So earnings growing at 38%, earnings per share growing at 39%, when they've only brought in revenue growth of 26%. So perhaps Apple can continue to do this. So we do have the sustainability checkbox covered. When it comes to supportability, we have to ask ourselves, is it supported by revenue growth? And again, we look to this revenue growth historically to answer that question as well. And you can see the trend has definitely been down, right? We're maturing. We're going from 26, 21 to 10 to 18 to 8. And you can see that we're forecast to only grow at 4%. Okay. What I want everyone to see here that's really interesting is that we're experiencing margin slippage here because we're going to actually generate 2% in EPS growth. At least the forecast over the next 4 quarters is only 2% in earnings growth relative to bringing in roughly twice that in revenue growth. And you can see that net margin forecast dropping from 25.7 down to 24.5. So a little bit lengthy explanation there, but that's kind of how we use this particular spreadsheet model. in our research lab, and it's applicable to all companies, and the analysis is roughly the same, right? So if we look at Microsoft, it's the same analysis, right? My eyes go right over here to this year-over-year shares diluted percent change column. You can see that we've got a buyback. If I just look at that same March 2022 quarter, you can see that we're basically manufacturing about 1% in earnings growth. In a minute, you'll see that 1% and 3% for companies like Apple and Microsoft can have an enormous bias on the S&P 500. And from a strategist perspective, these are things that we need to be aware of when we're managing portfolios and managing real money. Okay. So again, what you're going to see here is tremendous operating leverage that we traditionally see in software companies, right? They've sunk the cost, they've developed the software. Every incremental sale is just higher margin tickets. And you can see how successful Microsoft was with their operating leverage here in COVID. So they were basically producing 33, 43, 47, 48% earnings growth off of revenue growth that was roughly half that. So you can see that margin just expanding from 35.9 all the way up to 45.2. And we've heard the profit warnings. We know that Microsoft's getting hit with the strong dollar on overseas sales. And now you can see that net margin kind of, cascading down all the way down to actually a 32.3 for the June quarter. And you can see those growth rates slowing immensely as well. So where we had operating leverage here, you can see that kind of reversing its course in the March and June quarters. But keep in mind, this is coming off the back of large numbers, right? So we're going through this normalization process. We came from 43 and 47% growth, and now we're going down to 11 and 5%. So we're probably going to normalize out somewhere in the very low single digits, 10, 11%. But we've got some normalizing here to do yet for Microsoft. So a little bit tough to tell here as these forecasts change. But at any rate, what you'll see here on the trailing 12 is that from a cost cutting / margin perspective, we're still getting a little bit of operating leverage on the trailing 12, 18% revenue growth coming off of 21% earnings growth. When you take into account the trailing 4 quarter share buyback, it's only 20%. So a little bit closer to that 18%. And then you can see it actually reverse course here. So forecast 4 quarters, again, cost pressures coming in. You can see margins coming down to 34.4. We're looking at 11% top line growth, producing only about half that in earnings growth. Okay. So when we look at the sustainability and supportability of the actual earnings growth for Microsoft, again, we're looking at how much of it has been impacted by share buybacks. We do that by comparing the diluted numbers in terms of growth relative to the aggregate numbers. You can do it with revenues per share versus revenues, or EPS versus earnings. It doesn't matter. You can use either column. When we start talking about cost cutting, really all you're doing at that point in terms of your framework is just literally comparing, are they able to match their earnings growth with revenue growth? And if they haven't been able to do that, or they currently are not able to do that, then the question you have to ask yourself is, well, how long have they had experience in doing that? And is it sustainable, right? Can they continue to do it? In terms of share buybacks, right, it's the same question. Microsoft has been buying back their stock since at least 07. I didn't pull a history prior to 07 on this chart here, but you can see they've got a very long track record of buying back stock. So perhaps they're going to continue to do that in the future. So they may be able to continue to manufacture additional earnings growth. The question is, at what point, is the market actually paying for that growth? If it's sustainable and it's sustained over a long period of time, they're probably apt to pay a little bit more for it than if it was just an otherwise one-time event or a couple quarter event. So keep that in mind. The real issue is how this impacts the broader indices, and we're going to talk about that on the next slide. So again, keep in mind that these long-term least squares trend rates and these growth rates are super important when you're doing this type of analysis. You'll see operating leverage here kicking in over the 1, the 3, the 5, and even the 10. Okay, so you can see earnings growth outpacing revenue growth in each one of those time periods. And then what you see in the 15 and 20 is that revenue growth matches earnings growth. And that's what you want to see at a minimum. So that's just super, super healthy for Microsoft. Okay, so a good framework to have. So why is this important, right? Why is this important for Apple and Microsoft? Well, it's important to understand these concepts for doing individual security analysis. But again, what you want to do is have have this within some sort of greater context. And so back on September 6th, I actually started putting this webinar together. This is another spreadsheet that we use in our research lab internally here to basically monitor all sorts of biases that are going on in the S&P 500. For those of you that aren't aware, as of September 6th, the top 6 market cap, I should say the top 6 by market cap in the S&P 500, which stands at about 8.4 or 8.5 trillion, I'm sorry, in market cap in total, represents roughly 24.5% of the weight in the S&P 500. So if you think about PE ratios, you think about share buybacks and the biases going on with share buybacks in terms of earnings growth and everything else, I mean, anything else you can think of, right? Remember that the S&P 500 is a market weighted index. So these top 6 names are contributing 24.5% of the weight. Okay, just to give you some additional context, what does that mean? Well, if you started at the bottom of this spreadsheet and you went up, basically to get to 8.5 trillion, you'd have to sum up the market cap of the bottom 364 names. All right, think about that. The top 6 in weight equals the bottom 364 names in the S&P 500. All right, let's couple that with the Standard & Poor's estimates for share buyback expense on that 1% excise tax that was just passed. So S&P has estimated that 21.3% of companies in the S&P 500 increased their earnings per share or EPS by at least 4%, right? We've already seen that. We saw Apple with 3%. So that's 21% of the companies in the S&P 500 increased their EPS by at least 4% thanks to that newly lowered share count. And so what does this equate to if we were to have that excise tax kick in right now? So I've actually got the top 5 for you. I don't have Facebook up here because it's no longer a top 6 company. It's actually slipped quite a bit year to date. But Facebook is actually clocking in at 501 million in terms of their excise tax liability if this were to be in effect right now. But and again, this has all been estimated by S&P. You can see Apple sitting in the number 1 slot here, 877, Microsoft at 275, Alphabet at 503, and then Berkshire with their share buybacks at 271. But just look at Apple and Microsoft, right? We were just talking about how much growth they've manufactured from share buybacks. And, that's 12.5% of the S&P 500 just in those 2 companies as of September 6th. So something to keep in mind from a macro perspective. Again, when you're utilizing this type of a framework, how does it impact these companies individually? And then what is it doing to the biases in the indices, right? And if this were all of a sudden to slow down, right? Because Apple and Microsoft, I mean, they've been doing these share buybacks for years. I mean, how much more stock are they really going to be buying back? And if they're getting taxed on top of that, if this slows down, what does that mean for S&P 500 earnings growth and the multiple that gets applied to that in the future? So all sorts of things to consider here. Okay. So if we go back to ADP, we'll just bump through this really, really quickly. You can kind of get some repetition here on how easy this is. Again, that framework, you can see ADP also has a share buyback. Another reason I wanted to show you this is just how prevalent these share buybacks are. And the type of growth that's being manufactured. Here the March quarter, again, here's another 2%. It was 2% in the December quarter. It was 2% in September 21. It was 2% in June, right? So tons of growth being manufactured here by these share buybacks, okay? Note that for ADP, again, the cost cutting, right? You're talking about manufacturing 15 to 17% earnings growth on top of only 10% revenue growth. So you have to ask yourself, well, how long has ADP been doing that? They've been successful at doing that for 20 years. And you can see that down here. It's only been in this last year that they've grown revenues higher than their earnings. So again, when you see that relative to everything else here, you can point to a little bit of margin slippage. And we know what's going on with costs these days are doing nothing but rising, right? But you can see here 3, 5, 10, 15, and 20 year. earnings outpacing revenue growth. Okay, so a lot of experience here for ADP, and a lot of it is that roll-up model that they have, right? That acquisition model. They acquire the revenues and then they strip out the costs. Okay, and that tends to lead to quite a bit of operating leverage over time. So this is something that ADP has a lot of experience with, and they're very good at it. So again, understanding that business model and how it actually fits into the framework can be super important. Okay. And again, those share buybacks literally going on since 07, probably going on longer than that. I just don't have it here for you on the chart. It's only going back to 07. All right. The next slide is literally just a slide that I pulled at random. Actually, not a slide I pulled at random. It's a company I pulled at random out of the S&P 500. I literally just grabbed one and took a look at it. And it's Bank of America. I figured, why not, right? We're not going to spend a whole lot of time on this. I just want you to see random company, right? Here's one with literally a 6% buyback in the most recent quarter, 6.6%. And you can see that they manufactured about 5% in terms of earnings growth, which is just enormous, okay? And Bank of America has been buying back stocks since 2013, right? What happens if this were to slow down across the board, right? What happens if these excise taxes actually slow down share buybacks? Share buybacks are one of the preferred ways in which companies can return capital to shareholders. Most popular, obviously, being dividends. But we have to look at not only the implications for each company, but what this actually means in terms of S&P earnings going forward if this were to happen. So we're going to start looking at our stable earnings family of core equity portfolios here shortly. And it's just really important that you understand the framework and how we evaluate this whole concept of sustainability and supportability of earnings growth. And when you're manufacturing 5% earnings growth out of share buybacks alone, let alone operating leverage or cost cutting, those components, you've got to understand and have a solid framework for how to analyze growth. So, but that's about it for today's session. Thank you for attending. If you have any questions or requests, please leave a comment or email us directly at info@pacificpoint.net. And be sure to connect with me on LinkedIn at Tim Nyland. To receive our research, please visit us at the Pacific Point website at pacificpoint.net and click on the Research Lab tab and sign up to receive our research delivered directly into your inbox. Again, thank you all for attending.